Ray and Pam live in Scottsdale, Arizona. They retired 2 years ago with $300,000 saved. They put most of it into a popular covered call ETF. The yield said 12%. That looked like $36,000 a year, $3,000 every single month. They felt great. Then Ray checked the actual account balance. It was $245,000, not $300,000. $55,000 had quietly disappeared. And the strangest part, they never missed a single monthly deposit. The checks kept coming, the account kept shrinking. That is not a made-up story. That is the exact math behind one of the most popular dividend ETFs in America. It launched at $25 a share. Today, it trades around $17.66. 12 years of income, and the share price dropped 29%. So here's what this video is about. By the end, you will know 5 dividend ETFs that can pay you every single month and grow your money at the same time. One of them delivered a 23% total return over the past year. And I will show you the one number that tells you instantly whether any dividend ETF is building your wealth or quietly draining it. And the part most people never check, there's a free document that every fund is legally required to publish. Almost nobody reads it. I will show you exactly where to find it and how to use it. Quick note, I am not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now let me show you the myth that tricks more dividend investors than anything else. Once you see it, you cannot unsee it. Myth number 1, the bigger the yield, the more money you make. Here's the myth, and I believed it too when I first started. If one ETF pays 3% and another pays 12%, the 12% makes you more money. Seems obvious, right? Let me show you what actually happens. Take $10,000 and put it into QIYLD, the Global X NASDAQ 100 Covered Call ETF, the day it launched back in December 2013. That 12% yield feels amazing. Over the years, you collect roughly $14,000 in cash distributions. Sounds like a winner. But here's the part nobody talks about. Your shares are now worth about $6,500. You started with $10,000 in shares. Now you have $6,500 in shares plus $14,000 in cash. Your grand total is roughly $20,500. Now take that same $10,000 and put it into QQQ, the plain NASDAQ 100 index fund. No special yield, no covered calls, just the index. That $10,000 grew to over $30,000 on price alone. The boring fund beat the amazing yield fund by almost $10,000. And here's the number that matters. Total return. That's the only honest scorecard. Total return means price change plus all distributions combined. Did your whole account go up or down? That's total return. QIYLD's share price has fallen roughly 2% every single year for a decade. The income felt real, but part of it was your own money being handed back to you in smaller and smaller pieces. Here is the truth. Yield is the advertisement. Total return is the actual product. And if you only read the ad, you will never know what you actually bought. Think about that for a second. 2 funds, same 100 stocks. One returned over 700% on price, the other lost 29% of its share value. The only difference was how they handled the income. Now, you might be thinking, okay, I will just check my total return and I'm fine. Not so fast, because there is a second trap hiding inside that monthly deposit, and this one is harder to spot. Myth number 2, if it pays me every month, my money is working. Here's the second myth. I got my deposit this month. That means the fund earned it. This is where it gets sneaky, because some funds pay you with money they did not earn. They pay you with your money. Let me explain. Every ETF holds a basket of investments. Those investments have a total value. Divide that value by the number of shares and you get the net asset value, NAV for short. Think of it as the real price tag on everything inside the fund. Now, here's the problem. If a fund earns $5,000 but pays out $12,000, where does the extra $7,000 come from? Your principal. The fund sells its own holdings to write your check. That's NAV erosion, and it's the silent killer of dividend portfolios. Want proof? Look at IWMY, the Defiance Russell 2000 fund. It launched at $27. It pays roughly 30% per year. Sounds incredible, right? But today it trades around $18. That's a 33% collapse, and its SEC yield, the one that measures real earnings, is actually negative 0.95%. Up to 100% of its distributions have been return of capital. They're not paying you income, they're mailing your savings back to you in smaller and smaller envelopes. Here's another one, TSLY, the Yield Max Tesla Fund. Tesla stock rose 120%, but TSLY, the income version, fell 64%. Same company, opposite outcome. 100% of its distributions were return of capital. Owning the income fund cost you the entire rally. Now here's the important part. Not all return of capital is bad. Some funds use a strategy with index options that creates return of capital on paper, but the fund is not actually shrinking. The NAV stays flat or even rises. That's called constructive return of capital. It's a tax feature, not a warning sign. I'll show you exactly which funds use it the right way in a few minutes. But first, here's how you tell the difference. Check number 1. Every fund that pays distributions publishes a document called a 19A-1 notice. It breaks down exactly where your money came from, real earnings or return of capital. You can find it on the fund's website under Tax Information or Distributions. That's your first check. Check number 2. Pull up the fund's price chart, not 1 month, not 1 quarter, 3 to 5 years. Is the line going up, flat, or sinking? If it's sinking while the yield looks amazing, that's NAV erosion in action. You have your answer. 2 checks, takes 5 minutes, could save you thousands. Here's the myth. A monthly deposit means the fund is earning. Here's the truth. A monthly deposit only means money moved. The price chart tells you whether it was earned or taken from your own account. Before I show you the third trap, drop a comment right now. Have you ever owned an ETF where the yield looked great but the share price kept falling? I want to hear your story. I read every single comment. So now you know the first 2 traps, chasing yield and ignoring where the money comes from. But there is one more, and it is the one that locks the door. It is the reason some funds can never grow, no matter how good the market gets. Myth number 3, covered calls are safe income, plus the 5 ETFs revealed. Here is myth number 3, and this is the one that costs the most. Covered calls are safe income. They can be, but only if the fund does it right, and many of the most popular ones do not. Let me explain covered calls with a simple example. You own a house worth $200,000. Someone offers you $5,000 right now for the right to buy it at $200,000 anytime in the next 90 days. You take the deal. You pocket the $5,000. Then the market jumps. Your house is now worth $280,000, but you agreed to sell at $200,000. You collected a $5,000 premium and you missed $80,000 in gains. That is a covered call. Now here's what matters. How much of the portfolio does the fund cover? QYLD sells calls on 100% of its portfolio, right at the current price. That means nearly all the upside is capped, every single month. The NASDAQ source, QYLD, barely moves. But what if a fund only sold calls on part of the portfolio? And what if it sold them above the current price, not right at it? Then you'd keep most of the upside and still collect the premium income. That's exactly what these 5 funds do. Let me walk you through each one. Fund number 1, SCHD, the Schwab US Dividend Equity ETF. I call this one the foundation. It pays a 3.25% yield. I know that doesn't sound exciting, but its total return over the past year was over 23%. The share price is near all-time highs. The expense ratio is 0.06%, almost free. And here's the kicker. SCHD has raised its dividend every single year since 2011. Never cut, never frozen. The dividend has grown roughly 11% per year for over a decade. Now, SCHD does pay quarterly, not monthly. March, June, September, December. Think of it as the anchor that grows your base while the other 4 handle monthly cash flow. While QYLD's price fell 29% over 12 years, SCHD's price climbed to record highs, same time period. Very different result. Fund number 2, QDVO, the Amplify CWP Growth and Income ETF. This one pays monthly, yield around 10.3%. Total return over 22% in its first full year. Here's what makes it different. QDVO writes covered calls on individual stocks, but only when the setup is right, not on 100% of the portfolio all the time, tactical coverage. NAV has stayed stable around $29. It's a smaller fund, about $600 million, and it launched in August 2024. Young, but the early numbers are strong. Fund number 3, JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. Monthly, yield around 10.5%. Total return near 28% over the past year. NAV went from $51 at launch to roughly $59 today. JP Morgan uses out-of-the-money calls through equity-linked notes. The top holdings are Nvidia, Apple, Alphabet, Microsoft, Amazon. Nearly $40 billion in assets. One honest note: distributions are taxed as ordinary income. This one works best inside an IRA or Roth. Here's the contrast that tells the whole story. QYLD and JEPQ both hold NASDAQ 100 stocks. QYLD's price fell 29%. JEPQ's price rose from $51 to $59. Same index, opposite outcomes. The difference is how they handle the covered calls. Fund number 4, SPYI, the NEOS S&P 500 High Income ETF. Monthly, yield around 12%. Total return over 23% since launch. NEOS uses S&P 500 index options with partial coverage. They also use Section 1256 contracts, which means a 60-40 tax split and active tax loss harvesting. Now, here's the nuance. About 95% of SPYI's 2026 distributions are classified as return of capital. But remember the two-check system? Pull up SPYI's price chart. It is stable to rising. The NAV is not shrinking. This is the constructive kind, a tax feature, not a warning sign. SPYI passes both checks. Fund number 5, QQQI, the NEOS Nasdaq 100 High Income ETF. Monthly, yield around 14%. Total return near 30% since it launched in January 2024. It won Best New Active ETF at the 2025 ETF.com Awards. Same NEOS strategy as SPYI, but on the NASDAQ 100. Over $12 billion in assets in just over 2 years. Same constructive return of capital structure. One honest note on QQQI. It trailed plain QQQ by about 9 points over the past year, 29% versus 38%. That is the cost of the income. You keep most of the growth, not all of it. That is the trade-off, and you should know it going in. Let me put all 5 side by side so you can see the full picture. SCHD, yield 3.25%, total return 23%, NAV rising, expense ratio 0.06%, pays quarterly, quality dividend growth. QDVO, yield 10.3%, total return 22%, NAV stable, expense ratio 0.55%, pays monthly, tactical covered calls. JEPQ, yield 10.5%, total return 28%, NAV rising, expense ratio 0.35%, pays monthly, out-of-the-money calls. SPYI, yield 12%, total return 23%, NAV stable, expense ratio 0.68%, pays monthly, partial S&P 500 coverage. QQQI, yield 14%, total return 30%, NAV stable, expense ratio 0.68%, pays monthly, partial NASDAQ coverage. Now compare that to QYLD, yield 12%, price down 29% over 12 years, 100% coverage, capped all upside, or IWMY, yield 30%, price down 33% in months, up to 100% return of capital, negative SEC yield. Same category, completely different results. The difference comes down to 3 things: coverage ratio, earnings quality, and NAV direction. So those are the 5, but knowing the funds is not enough. The question most people ask next is, how do I actually put them together? How much do I get every month? Let me show you. Your monthly income blueprint. Here's how these 5 funds work together. SCHD is the foundation. It grows your base and pays you a quarterly bonus in March, June, September, and December. The other four, QDVO, JEPQ, SPYI, and QQQI, handle monthly income, and they pay on different dates. JEPQ around the 1st of the month, SPYI around the 16th, QQQI around the 20th, QDVO around the 28th. That means cash hitting your account multiple times every month, plus a quarterly bump from SCHD. Now, let me show you the income math. If you split your investment equally across all 5, the blended distribution rate comes to roughly 10%. At $100,000 invested, that is approximately $833 per month. At $250,000, roughly $2,083 per month. At $500,000, roughly $4,167 per month. Now, and this is important, these numbers are not fixed. Distributions change every single month based on market conditions. When the market is calm and volatility is low, option premiums shrink. That means smaller checks. That is normal. That is how these funds work. Do not panic when one month is lower than the last. These are estimates based on recent distribution rates. They are not guarantees. Past returns do not promise future results. Always keep that in mind. Before you buy any dividend ETF, anyone, not just these 5, ask 3 questions. Question 1, what is the total return over multiple years? Not 1 month, not 1 quarter, multiple years. If the total return is strong, the fund is doing its job. Question 2, is the share price flat or rising? Pull up the chart, 3 to 5 years. If it is sinking while the yield looks amazing, walk away. Question 3, where does the income come from? Find the 19A-1 notice on the fund's website, real earnings or return of capital. If it is destructive return of capital, that is your own money coming back dressed as income. 3 questions, 5 minutes. That's all it takes. Income should feed your life, not eat your savings. Remember Ray and Pam? They were watching $55,000 disappear from a $300,000 portfolio while celebrating a 12% yield. What if they had split that same $300,000 across these 5 funds instead? At a blended 10% distribution, that's roughly $2,500 a month in income. And based on recent total returns, the portfolio would have been growing, not shrinking. Same starting money, very different outcome. If you know someone chasing a big yield number right now, a friend, a family member, someone in your investing group, share this video with them. It could save them a very expensive lesson. Tell me in the comments, which of these 5 ETFs are you most interested in? Or do you already own one of them? I read every single comment and I will reply. If you're building income that lasts, not income that eats itself, subscribe to this channel. Every video is designed to protect your money and help it grow. And in the next video, I'm breaking down exactly how to build a complete 3-bucket portfolio using these funds: foundation, growth, and income. From scratch. You do not want to miss that one.